Now, folks, I'm one of those people who really love Singapore. I'm very unashamed about that, which is why a good part of my portfolio is made up of Singaporean companies. But don't just take it from me. Our next speaker has over 25 years of experience providing trading and investment analysis of financial markets. He's known as the chart man on CNBC, and he's here to tell you some things about Singapore's Straits Times Index that may surprise you on the upside. Please welcome Mr. Daryl Guppy.
Ladies and gentlemen, welcome and thank you for attending today. It's a pleasure to be with you, even though these are fairly difficult times. So what does the Singapore market have to offer us in these times of uncertainty? There are so many things to worry about. We've finally got the interest rate rise out of the United States, and that's going to flow through over the next couple of months into our markets. There's the ongoing conflict in Ukraine. That's impacting on markets. There's still residual COVID, and there's the prospect of inflation. So many things to worry about, and yet the return on our capital, particularly from the banks, remains very, very low. How can we do better? So today, I'm going to show you why investing in the market and easy ways to invest in the market gives us the best protection in these uncertain times. If we have spare money and we put it on deposit in the bank, at the moment, the average rate of return is 0.6%. That's miserable, a 0.6%. And yet, by putting it into the market, we can generate returns of 30% or better. But it's not just a matter of throwing it at the market. There are three areas that give us reasonable sorts of returns. The first that we must consider is what I would call must-do services, the things that we cannot do without, the services we have to use every day, and that's not just getting a cup of coffee at Starbucks. Then there is unavoidable expenditure. When we have to spend money, someone else receives it. So those companies that rely on unavoidable expenditure are the ones that are going to thrive in these markets. But of course, many of you will say, I've got no time to decide. I really don't know how to do this. I'm just happy to leave it in the hands of the professionals. Now, I would disagree. I think that you do have time. Investing in the market does not need to be a time-consuming and complex process. Markets have changed, and the sorts of instruments, the types of things that you can trade and invest in, have also changed. And that makes it much, much easier to manage your money, to manage the opportunities. So where do we start? Let's start, first of all, with services that you need to use. These are the must-do services, the ones that you can't do without. No matter what happens, you're always going to be using these services. And the banks are a good example, because come rain, come hail, come shine, we have no choice. We have to use the banks. So therefore, their business model is always going to survive no matter what we're worrying about, no matter what the economic conditions are. This means that we need to understand what is happening with each of the bank stocks. And we'll just look at a couple of examples to show you the sorts of returns that are available from simple analysis, not intraday trading, not fast trading, longer term investment. In the first example, I'm going to use the simplest of indicators, just two moving averages with the crossover point developing an entry signal. This is DBS on a weekly chart. Take an entry at $22, and for the purposes of this discussion, we'll take an exit at $32.50. That gives us a whopping 47% return over 12 months in 2021 up until March 2022. A 47% return based on just a simple signal from two moving average crossovers. It can't get much more simple than that. Now, as many of you know, I like to use a Guppy multiple moving average to understand the trend and its trend behaviour. So let's apply that to another bank stock. This is a mid-trend entry. With DBS, we were looking for a breakout entry, a change from a downtrend to an uptrend. With OCBC, as we move into 2021, it's already in a well-established uptrend. So what we're looking for is to enter at a point of weakness. Now, the long-term group of moving averages, those in red, show us that OCBC is still well supported by investors, so it's pretty safe to take an entry at $10.30. But as we move towards the middle of 2021, OCBC begins to lose momentum. It hits a high, pulls back, touches the bottom of this long-term group, moves up, not quite as high, and then begins to retreat. That's an indication that that uptrend is losing momentum. We get out at $12.45, and that gives us a 20.87% return. It's a lot better return than putting our money into the bank. By buying the bank stock, we're outperforming the 0.6% interest that would be paid from cash or long-term deposits. It's a different technique, joining a well-established trend and continuing to trade that trend until it shows signs of weakness. Now, we don't have to get the very bottom and the very top of the trend. That's what we see in the next example. When we are trading these must-do services, yes, we do have to select individual stocks that we think are going to deliver the returns that we want. So there is some trading skill involved in this. But we simply have to recognize when a trend is developing. When we look at UOB, we can see that there's an extended period in 2021 where there is no real trending activity. We simply avoid that. There are better opportunities in OCBC and DBS because they were strongly trending stocks. However, UOB does develop a strong uptrend at the beginning of 2022, this fast rally. Okay, it only lasted for January and February, but by using a count backline technique, not particularly advanced, but it's easy to apply, by using a count backline technique, we get in at 27.55, we get an exit signal at 32.30. That's a 17% return in 2 months. Think about it, 17% return in 2 months using an entry and exit signal that can be calculated in 10 seconds. This is why the market is the best way to expand and grow your capital. But what about expenditures that we can't avoid? The companies that are involved in providing that also opportunities. But again, there is some selection required for individual stocks. Singapore. Everybody wants a condo. Owning a condo is a difficult process. But just imagine that you can own the keys to hundreds of condos. The exchange-traded funds give you the opportunity to do this. With a single purchase of an exchange-traded fund, you can take part of the rent from hundreds of condos, commercial enterprises, office buildings throughout Singapore, throughout the Asia Pacific. Now, of course, in the disruption posed by COVID, this was not quite as good as we would have liked and as it has been in the past. But nevertheless, opportunities still existed. Exchange-traded funds give you the opportunity to bring together a bundle of stocks that are operating in a particular area. In this case, we're looking at REITs, but you could be looking at metals, you could be looking at automotive supplies, you could be looking at health supplies. There are now ETFs that cover a whole range of independent industry areas. This is an opportunity for you to say, yes, I think that health services are going to benefit a great deal during the COVID pandemic. I don't know which one to buy. It's like the banks. Which one is best? I have to make a decision. But by taking an ETF, the ETF makes that decision for you. It exposes your trading, your investment, to an entire market sector with just one purchase. Now, there is still a risk that that sector may not perform as well as you anticipate. That's always an investment risk. But by bundling all the sector stocks together into a single instrument, a single ETF, it makes it easier to trade that particular sector rather than trying to pick an individual stock that's going to replicate what the sector is doing. Now, of course, the commercial rental sector during COVID 2021 was not the best place to be. And I want to show you this in particular because I want to show you that there are still opportunities that exist in these sectors. You have to be a bit more agile, you have to be a bit more active, but the opportunities are still there. So if we're buying AIM's APEC REIT, which covers commercial property outside of Singapore as well, and we get a simple move above this downtrend line and we enter at 121 and we exit when we have a close below the uptrend line at $1.43, we get an 18% return. Yes, it's more akin to trading than to longer term investing. But when this trend break develops here, we don't know it's only going to last 4 or 5 months. We anticipate that this trend is likely to continue for a longer time. The key factor: the ETF gives you exposure to your preferred sector. You're making a decision about what you think is the best industry sector. But of course, some of you will say, look, I don't have the time. I don't have the time to worry about individual stocks like DBS or OCBC. I don't have the time to pick through a smaller selection of ETFs to decide which is the best sector that's going to perform. I just simply don't have the time. So how can I maximize my capital returns from investment by investing in the Singapore market? And the answer is simple. This is the answer for lazy investors. Now, lazy doesn't mean silly or uninformed. Lazy is an intelligent response to investing in the market. It allows you to sit back and relax and just watch your money grow, because what you're doing is you are replicating the performance of the underlying index. And the underlying index always goes up. What do you mean it always goes up? The Singapore index goes up and goes down and goes up. Everybody does that. Yes, that's true in the short term. But in the long term, the Singapore index, the STI, or any market index, always goes up. And the reason is what's called survivor bias. Understanding survivor bias is what gives us the confidence to invest in the ETF that tracks the index. Think of the Titanic. When the Titanic went down, there were lots and lots of people who lost their lives. It's only the survivors who lived to tell the tale of what happened. And it's the same with the market index. Because every 3 months, sometimes a little less frequently, sometimes more frequently, depending on the index, but every 3 months, the index is restructured. Those stocks that are underperforming the market are deleted from the index, and they are replaced with stocks that are outperforming the market. This is what we mean by survivor bias. It means that the index only contains stocks that are winners. And the important thing is, you don't have to try and select those stocks that are winners. That's done for you by the index managers. So the easy way to accumulate capital and returns, the easy way to watch your money grow, to be able to sit back and relax and watch it grow, is to trade the index, to invest in the index. And for that, there are a number of exchange-traded fund index trackers. Here's the SPDR Straits Times Index on a weekly basis. We're using just a simple trend line to give us our entry point, our entry signal, the 255. We're also, in this case, using a drop below this uptrend line as our exit signal. That gives us a 25.9% return. However, if we didn't take this exit signal, if we exited up here at $3.45, that gives us a 35% return, which of course is what we said at the beginning of this presentation, how to make 30% from the STI index. The ETF approach is very important. It recognizes that over the longer term, markets will always go up. The index always goes up because of the survivor bias. The index only includes those stocks that are outperforming the general performance of the index. Now, certainly, we can use trendline analysis or some other techniques to identify when is the best time to enter after a pullback and the beginning of a rebound. That's our preferred method. You don't have to use exactly the same methods. Many people will try to convince you that investing in the market is difficult, so difficult that it ought to be left only to the professionals. I would suggest that just using simple analysis techniques and selecting in those correct areas services that you cannot go without, services that you have to use, or tracking the general index behavior will deliver better returns, because the market doesn't have many choices about how it's going to behave. Here are the options. You either have a break from a downtrend where the price begins to move up, or you have a mid-trend entry, which is where there is already an established uptrend and you buy at a point of temporary weakness where the market pulls back and then the uptrend continues. They are the two main trading and investing opportunities: a breakout from a downtrend or joining an established uptrend. The third option, of course, is when the market is simply moving sideways. And unless you're a skilled trader, there are not good long-term opportunities available in a sideways market. So how do we find these downtrend breakouts or these uptrends where we can join in mid-trend? And the answer is simple. It's an eyeball exercise. Simply looking at this chart of behavior tells you that this is a breakout. Looking at this tells you that this is an established uptrend and not likely to change very quickly. The eyeball, just looking at the charts, is the simplest and most effective tool that you have. There is no question. Investing in the Singapore market is the best and most effective way to grow your capital. And today, I've shown you 3 simple methods that you can use to achieve this objective. If you are interested in exploring these ideas further, then I suggest you have a look at Stocks and Forex Trading that develops these ideas to a greater extent and in more detail. Or you can subscribe to our newsletter that we've been running for 25 years, where we have a 70% selection rate success. I wish you every success in your trading and with your involvement with Singapore Stock Exchange.